All right, my friends, I cannot wait to share this one with you. Is home equity underutilized in retirement plans? That's what we're going to talk about here today. And we're going to look at an article from the Centers for Retirement Research at Boston College, one of my favorite research entities when it comes to retirement planning. I just love these guys. And this is a wonderful, wonderful paper we're going to look at, dated March 2017. If you're looking at just your own, you cannot go wrong by going here, crr.bc.edu. Alicia Munell, I think, is still the chief of this place. I just so much stuff on here. When I was doing my master's, I came across Munell, Soto, just tons of guys and ladies who do the research on financial planning, and I would have been lost without it. And CCRC. Or CRR, I don't know why I keep, because Continuing Care Retirement Communities. CRR, the Center for Retirement Research at BC, man, I tell you. So go on here and sign up, and for their newsroom, follow them. The whole thing is, you can't go wrong. All right, so we're going to look at this one. This, again, is dated March of 2017, and my mug is gone because I want to open this up so you can see this whole article. By a guy named Stephen Sass, and Stephen is a research economist at the CRR. I get used to not calling CCRC. CRR is home equity, an underutilized retirement asset. And we're just going to read this because it's critical. Retirement planning generally focuses on the use of financial assets. However, home equity is the largest store of savings for most households entering retirement. This brief reviews studies by the Social Security Administration's Retirement Research Consortium and others that assess if home equity is an underutilized retirement asset, and if so, why? Yep, we're going to talk about that. In fact, what we're going to show you here is that here is a top 5 quintiles for people aged 65 to 69 in 2012, and I can almost assure you it hasn't changed much. And this is quintiles of wealth, and what you're going to see is up until the last of wealthiest 20%, home equity was either equal to or dwarfed any other household worth by far. So in the 60% of the population, home equity, it wasn't close relative to financial assets. Home equity of people's financial wealth, home equity was by far and away the vast amount of wealth they had. And it was nothing came close. Even in the third quintile, $105,000 of home equity versus only $40,000 of financial wealth. When you're in the fourth quintile, so that means the top 20, the 80% or beyond in the fourth quintile, from 61% to 80%, wealth, they had the same amount of home equity as they had in liquid net worth. There's only ones who got the most wealthiest did their financial assets dwarf their home equity. Up until that point, it wasn't close. So the vast majority of Americans, if they're not looking at their home equity, they're just leaving a lot to be desired when it comes to retirement planning. The return or income that financial assets produce is an increase in the price of these assets plus dividend or interest. The return on home equity has 2 parts: the rise in the price of the house plus the provision of in-kind housing services. U.S. home prices have averaged about 1% a year over inflation for the last 45 years. Of greater significance, though, than house price appreciation is the provision called in-kind housing services, and I cannot stress this enough. The market rental value, called imputed rent, is estimated at about 3 to 4% of the value of the home, much more than the value of the rise in home prices. Unlike interest or dividend income, imputed rent is not subject to income taxation. The value for in-kind services that home ownership provides goes beyond imputed rent. These services continue for as long as the retiree remains in their house, which offers valuable protection against longevity risk and rent increases, maintains connections with nearby family, friends, and community amenities, and allows the elderly to modify their home to suit their changing needs. I cannot stress this enough. Nakajima and Telyukova used a structural model and data from the Health Retirement Study and estimate that retirees value home ownership as over 3 times the imputed rent. All right, I want to talk about imputed rent. So you think about it. If you own your home, that means you have to pay rent. Yeah, yes, you still got to pay property tax and homeowners insurance. I get that, but it'll be significantly lower than rent. So if I had to rent and it cost me $2,000 a month in rent, That means I had to generate $2,000 a month in income. When I generated that income, it was taxable to me as income. However, because I don't have to generate that $2,000 a month in rent, that means I don't need to generate that $2,000 a month in taxable income, which means I pay no tax. So not only does rent cost me $2,000 a month, which I don't have to pay if I own my home outright, but I don't have to pay tax on that $2,000 a month either. That's imputed rent because you're getting it rent free. And on top of that, because you own it, you don't have to worry about rent increases. My wife and I, we used to know these neighbors when we lived in Dayton, Virginia, and they had a house they rented, and they've been there for like 30 years. And the owner, never raised rent. They're paying like $100 a month for it. I mean, that's not likely, but I'll never forget. They said, "Man, we just lucked out. $100 a month for a decent little home in Dayton, Virginia was quite cheap, just because I had a good landlord." Final difference between home equity and financial savings is liquidity. Home equity is much harder to tap. The primary ways are downsizing and reverse mortgage, and are costly and time-consuming as well. Households often enter retirement with excess housing. Empty nests have unused space and are often located in neighborhoods best suited for a different stage of life. Such households could strengthen their finances by moving to a less expensive home. A study by Munell, Soto, and Aubrey, using a nationally representative survey of workers approaching retirement, nevertheless finds that only 3% choose to plan to downsize. In fact, another study using the Health and Retirement Study survey finds that 30% of homeowners approaching retirement move, but they move more to a house that's more expensive rather than less expensive. And the ones that do move to a less expensive house do so because of a financial shock like Medicare or medical expense. Crazy. Staying in a house that has more space than one needs is costly. A study by Boutrica, Goldwyn, and Johnson, using, again, the HRS Consumption and Activities Mail Survey, finds that taxes, insurance, upkeep, and utilities account for 30% of retired homeowners' expenditures. And I'm going to do another video where I'm looking right now. You can't see on the podcast, so I open up the PDF of the Understanding Expenditure Patterns in Retirement, the paper they did, Barbara Boutrica, Joshua Goldwyn, and Richard Johnson, that they just referred to. And they talk about utilities being such a big expenditure for retirees' consumption. And the way I look at it is two things: not having LED light bulbs, and then having a third and fourth bedroom that you got to heat and air condition that no one ever goes in. And so that's just wasted heating and air conditioning, which is wasted utilities. And that means you're simply wasting money that you probably could use other way better. So that's another reason to consider downsizing. But it's not only households nearing retirement that do not downsize. Moving is more physically demanding and emotionally disruptive as retirees age. And studies by Venti, Wise, and others show that very few households downsize as they retire. Those that do typically give up home ownership towards the end of life in response to a trigger event, going to a nursing home, for instance. Widows often need to reduce, or becoming a widow. Widows often need to reduce expenses as the household's income from Social Security and pensions drops because there's only one spouse left anymore. And maintenance costs for survivors unable to do much maintenance themselves increases. Renting also makes more sense towards the end of life as the value of the housing services that home ownership provides over the retirees' remaining lifespan declines relative to the value of alternative uses of the savings held as home equity. A study by Coyle and Milligan nevertheless finds that widowhood alone lowers the probability of continued home ownership by only 3%. It lowers the probability by 12 percentage points if the survivor has an activity of daily living limitation. So basically, that's one of the 6 activities of daily living that long-term care insurance kicks in. So about 2/3 of all households that enter retirement owning a home, thus exit retirement owning a home as well. So the likelihood is you're not going to be renting when if you go into retirement owning a home, you're most likely going to be as well. Potential reasons for the lack of downsizing, in addition to the high costs and strong preference for remaining in one's home, includes a desire to use the home equity as a reserve or to leave it as a bequest. Various non-rational behavioral impediments also could stand in the way as well. These include the complexity of accessing the benefits, present-mindedness, giving excessive weight to the near-term costs while minimizing the long-term gains, endowment effects, excessively valuing what one currently has, and inertia. Yep. Analysis by paralysis, that's for sure. Or paralysis by analysis, that's what it is. To the extent that this resistance is primarily behavioral, with downsizing improving the household's well-being, home equity is definitely an underutilized retirement asset. I do want to talk about one thing here real quick. Excessively valuing present mind giving excessive weight. Present mind is giving excessive weight to the near-term costs while minimizing the long-term. Remember, my friends, a home equity conversion mortgage, a reverse mortgage, if you take the line of credit today, it will most likely never be as cheap as you do today as if you wait. And the reason for that is because the costs are based on the fair market value of your home. And so if your home is going to appreciate in value, as most likely it will, that inherently means the cost will go up in value as well, because it's the HUD, the guarantee for the FHA, they make it so it's based on the percentage of the asset of the home, not the amount that your line of credit is. And so if the home goes from $500,000 to $1 million, for instance, you've inherently doubled the cost right there for the mortgage insurance. And now if the home goes down in value, you would have wished you'd taken out before, but it went down in value because a home equity conversion mortgage is a non-recourse loan. You cannot owe more than the value of the home. So if the home goes down in value, you are not obligated to pay more than the house is worth, which again makes sense if you think you're going to stay in your home, to pay the fees up front, be done with it. And that way you can at least have that line of credit established now. And we're going to talk about how it's going to grow as you get older too, which is pretty interesting. All right. Given the value of placing, reverse mortgages, tapping home equity without moving. Given the value that retirees place on remaining in their current home and the high cost of downsizing, borrowing against home equity could be a more attractive way to access these savings. So you're not going to do it, my friends. Just, I'm sorry. A, you're going to have a monthly payment, which is going to hurt your cash flow. And B, the banks are very likely not to give you the loan because you still have to have the ability to pay it back. And mortgages are, especially home equity lines of credit, the underwriting are pretty strict, because what happened in 2008? I'm just telling you right now, the likelihood a bank is going to offer you terms if all you have is Social Security income, it's not likely to happen. A reverse mortgage is far more attractive and accessible. The key feature of a reverse mortgage is that borrowers are not required to make any payments as long as they live in the house. While borrowers do need to demonstrate the ability to pay property tax and insurance premiums, the loan must be repaid only when they move or die. Yep. Essentially, all reverse mortgages are now government-insured home equity conversion mortgages available to homeowners ages 62 and over. They're typically set up as line of credit to pay off a mortgage, eliminating debt payments, cover ongoing consumption expenditures, provide a reserve for medical or care expenses, or make an inter vivos transfers as during life. The government program assures borrowers they will get the contracted funds and assures lenders they will be repaid even if the balance owed exceeds the proceeds from the sale of the house. However, to date, only 2% of eligible homeowners have taken out a reverse mortgage. Most of borrowers who have trigger events, i.e. they have a healthcare shock, and then people that want to pay off their mortgages, so they don't want a monthly payment going in, so they just use a home equity reverse mortgage to pay off their mortgage. That's it, but only 2% of people doing it. Isn't that crazy? And a survey of households that considered a reverse mortgage but decided not to proceed, cost was by far and away the most commonly cited impediment. A home equity conversion mortgage on a $300,000 home costs about $9,000 up front, and the interest rate amounts borrowed was 5.9% in January 2017, with the rate adjusted annually. So a lot of people say, it's too expensive, I'll wait. That's bad. That's a big mistake, I'm telling you. If you're only going to do a line of credit, that's a big mistake. If you're going to do it to borrow, well, maybe not. But if you're doing it for a line of credit, I think that's a mistake. Let's see. All right. Mainly due to the high interest rates, households that use the proceeds of a reverse mortgage early in retirement could significantly reduce the equity available down the road, or that they want to leave as bequest, because you're tapping into your equity. That's just a fact. A reverse mortgage line of credit, though, can nevertheless be quite attractive, even to retirees who do not have immediate need for the funds. The amount they can draw from the reverse mortgage line of credit rises at this specified interest rate. Given the high interest rate, the amount retirees can draw from an untapped line rises quite rapidly, which allows the household to draw down its financial assets more quickly. So that means this: if you have a 5.9% interest rate, if you're not borrowing against it, that 5.9% interest rate is what is being used to have your home equity line of credit grow. It's growing at that 5.9%. Yes, it is expensive if you borrow against it. If you're not borrowing against it right now, though, it's growing at a 5.9% clip. It's nuts not to do that, in my opinion. I mean, everyone's got to look at their individual situation, but very few people move. Very few people downsize. Most people want to stay in their homes. There's tons of studies on this that show this now. Very, very few people actually relocate. Very few people relocate intrastate, never mind interstate. And so because that, we're most likely going to stay in your home. Get a reverse mortgage line of credit. Yeah, it's going to cost you something, but it's only going to cost you more in the future. A study by Davidoff also shows that the amount that older retirees can draw from an untapped line taken out at the beginning of retirement will be comparable to what they could get if they sold their house towards the end of retirement. A study by Sun, Triest, and Webb also shows that waiting to take a reverse mortgage is quite risky, as a rise in interest rates will typically reduce the value of the house as well as how much that line of credit reverse mortgage you could tap into. I cannot stress this enough. My friends, if interest rates go up, cost of homes go down. It's like a bond. Think about it like a bond. The interest rates go up, what happens to the price of the bonds? Bonds go down without question. Why? Because there's less demand on the current bonds that are out there. It's just that simple. But it's even more specific on homes. I mean, if I have a home for $400,000 house, and say it's $2,000 a month, because basically it's $500 a month for every $100,000 you borrow. Well, let's say $1,500 of that $2,000 a month goes to principal, and $500 of that $200 a month, $2,000 a month goes to interest. Now we raise the interest rates, and so now that $2,000 a month consists of $1,000 a month to principal and $1,000 a month to interest. That $400,000 will no longer generate the same demand, because a $400,000 home will not be affordable for someone who can only afford $2,000 a month in payment. It just won't. So now that person can afford a $300,000 home because they can't afford $1,000 a month in mortgage interest. They can afford $500 a month in mortgage interest. They can't afford $1,000 a month. So inherently, they are restricted by the value of the home by how much mortgage interest they have to pay. $1,000 a month going towards the principal will buy a whole lot less than a $1,500 a month going towards the principal. It is that simple. And if interest rates go from 4 to 5, the amount of interest, which will reduce the amount that goes towards the principal, will inherently make me have to reduce the price of my home, which means I'll also not be able to get such a high mortgage, reverse mortgage line of credit as well, simply because the fair market value of my home has dropped. I hope that makes sense. Interest rates do not work in a vacuum, man. I'm telling you right now, the higher the interest rates, the lower the value of your home. The lower the interest rates, the higher the value of your home, because it's all based on affordability of the buyer. If the buyer cannot afford $2,000 a month, of which $1,500 has to be used to principal, he won't be able to buy your house at $400,000. Just not going to happen. Given the value that reverse mortgages provide, the take-up rate seems largely explained by i.e. only 2% of the people doing them, explained by non-rational informational and behavioral impediments. Davidoff, Gerhard, and Post found limited product knowledge and widespread misconceptions. For instance, only 1/3 of respondents, for example, knew that they could stay in their homes even if they owed more than it was worth. More challenging is the fact that reverse mortgages are complex products that affect other key concerns, specifically bequest motives, medical and care risks, and securing an adequate standard of living. So, conclusion. Households entering retirement will increasingly need to tap their financial assets and home equity to maintain their living standards. While home equity has been the largest store of savings for most retirees, most households, retirees have generally resisted using it as part of their everyday retirement plan. They typically tap home equity only in a last case emergency scenario. Man, whether future retirees will exercise these options in using a reverse mortgage remains to be seen, but the pressures to do will be much more greater than they have been in the past. I tell you, folks, I cannot agree with that more. That's just a fact. If you have equity in your home and you're not considering it as a source of retirement income, I think you're making a mistake. And again, that doesn't mean you run out there and get the first guy to sell your reverse mortgage by opening his shirt like that, or his trench coat. I got a sale for you. No. You need to research it. Start with CRR, Center for Retirement Research. Go to my man Wade Fowles, get his book again. I've talked about this a million times a Sunday. Oops. But the issue is most people that watch this video are not in that upper quintile. That watch this YouTube channel are not in that upper quintile. I mean, some are, that's great. And you might not need to consider a reverse mortgage. But if you're in the 60% quintile and below, the likelihood that your home representing the vast majority of your net wealth is high. And that means, why would you not consider at least taking a reverse mortgage to alleviate some of the concern you have for retirement? I don't get it. So don't forget to subscribe, smash, share, a comment, and we'll see you guys next time at Heritage Wealth Planning. Thanks, Tom.